Hi everyone. I thought we'd go ahead and do a statement of retained earnings. Notice that the first thing you want to do with a statement of retained earnings, like all these statements, is get the structure down. Remember, we were working at the income statement. One of the first things we want to do is get our structure down on this, in this case, a single step income statement. What constitutes revenue? What constitutes expenses? What is revenue minus expenses? Income before tax, and then income tax, and then net income. Same thing we'll do here. We'll look and say, okay, what are the components that make up the statement of retained earnings? The first thing is the beginning of the period, December 31st, 2013, whatever retained earnings is. To that, we add net income, and then we subtract from that dividends declared, in this case dividends, and then we end up with our final answer for retained earnings. I want you to notice something that might be a little tricky, especially if you're not paying attention. You'll notice retained earnings is $2,900. So the adjusted trial balance has a credit for retained earnings. Right hand side has a credit of $2,900. Remember, when you declare dividends, retained earnings go down, so they're debited. You debit some out. You notice dividends is even a debit account. And as you earn net income, you credit retained earnings, and retained earnings go up. What I want to point you out to is when you look at this, it's easy to look at this and go, goodness, they're telling us what retained earnings is on December 31st. So you look up here and say December 31st, 2014, retained earnings 2,900. Your temptation is to put 2,900 down here and call that retained earnings. Retained earnings, December 31st, 2014. The reason you cannot do that is because you will remember that at the end of the period, we're creating financial statements now. At the end of the period, all the expenses are zeroed out and the revenue account is zeroed out. Remember, in this case, you have to close out the revenue account, so you credit service revenue 92,600, and then you debit, you credit all of these expense accounts. So you bring the expense accounts to zero, and you bring service revenue to zero by debiting it. It's got a normal credit balance as it accumulates, as you sell stuff, then you debit it out. All these revenue accounts have to be closed out. And when they're closed out, if you think about it, if you take 92,600 minus all these expenses, you end up with net income. This net income, which is the whole purpose of this statement up here, is closed, or it's added to retained earnings. Remember, we said retained earnings goes up as you earn net income. That's how we know that this 2,900 is not tied to December 31st, 2014. What you're looking at here is retained earnings 2,900 on December 31st, 2013. Okay, it's 2013, and the reason is you still see on the books expense accounts that have amounts, and you still see service revenue. If you saw service revenue zeroed out, if someone had debited service revenue 92,600 and this was a zero amount, and you saw nothing in the expense accounts that you're in other words, somebody had gone in and credited all these expense accounts to close them out and get them ready for the next year's use, then this would represent December 31st. But the fact that the expense accounts still have balances in them that they've accumulated throughout the year, and that service revenue still has an account on the trial balance, that means these have not been packaged. These have not been packaged together, closed out, and put into retained earnings. So when you're looking at here, it's a little bit misleading. This is not retained earnings at the end of the cycle. It's not December 31st, 2014. This is retained earnings at the beginning of the cycle. It will be, the retained earnings amount will be the correct at December 31st, 2014 when you close out all the expense and revenue accounts, which is the whole purpose of showing the income statement. So don't let this trip you up. When you look at this and you go, oh, what is the beginning retained earnings? This is the beginning retained earnings because we have not closed out these temporary accounts yet. We close them out, and then when we get to the very next year, 1/1, whatever the next year is, we're ready to start putting more revenue into the service revenue account as a credit, and we're ready to put more debits into the expense accounts. Okay, not to belabor the thing, what this means is we start with 2,900. And then we have net income. It's right here on top here, so you can just pull it down, 24,400. That gives you a total of 27,300. That just happens to be beginning retained earnings plus net income. And then your dividends, you pull right off the uh, trial balance here. If you look here, you will see dividends right here of 7,000. When you take beginning retained earnings here, 2,900 plus net income, minus dividends of 7,000, you come up with 20,300. I wanted to go through this slowly so you could see. I know you realize you can use this, help me solve this and all that stuff. Sometimes it's good though to have, the instructor kind of go through it step by step. The tricky thing here, the thing that's very tricky is when you look at this, oops, sorry, I didn't mean to hit OK. What's tricky when you look at this is that you have a tendency to freeze up and go, oh no, I don't know what beginning retained earnings are. I don't know what it is here in this case, 2013. Don't panic. What's happening is that it's sitting here. It's sitting here as a credit here on retained earnings. And the fact that you see these accounts with these expense accounts and the service revenue account, the fact you see a balance in them means they have not been closed to retained earnings yet. And ergo means retained earnings, that is beginning retained earnings. I hope you found this useful.